An uprising against Wall Street? Hardly. GameStop was about the absurdity of the stock market. For those of us who are as close to the internal workings of the stock market as with the circuit of the Large Hadron Collider, the brouhaha on GameStop was enlightening. While the story may seem esoteric, it explains the way economic and political power works today and reveals both the illogicality of the market and the access to institutional privilege. For those who do not know, GameStop is a United States video game retailer that lost most of its market share to online trading, and its stocks fell from $56 in 2013 to about $5 in 2019 and closed 450 stores this year. Some of the major hedge funds have decided to cash out the misery of GameStop by cutting their shares. It is a bet that the price of a short stock-like asset will go down. This is a maneuver that can generate huge profits, but if the asset price does not drop, investors can lose a lot of money as well. This is what happened with GameStop. A group of Reddit enthusiasts on the online forum WallStreet Bets, an investment discussion group with more than 6 million users, decided to buy GameStop shares collectively. Maybe they saw it as an investment, maybe they got bored, maybe they wanted to make Wall Street suffer. Whatever the reason, the result was to raise GameStop's share price. As it became a global story, others also piled up, increasing the share price from about $40 to $400 in just a few days. As a result, large investors lost a large hedge fund, Melvin Capital Management, or even forced to seek a bailout. You can naively imagine it exists to let people invest in companies, but stock trading generally has little to do with productive investment. According to author Doug Henwood, IPOs, the first IPOs where people could buy shares in private companies, have collected a total of $657 billion over the past 20 years. In the same period, companies in S&P 500 stock index spent $8.3 trillion to buy their own stocks to increase their price. A share buyback, a company that obviously buys its own shares to lower the current number and thus raise the price, is a form of market manipulation that was illegal in the United States until Ronald Reagan decided that banning it was to restrict market freedom. As a result, many companies are now spending money on their own shares rather than building factories. It helped boost the stock market to record levels and provided great generosity to shareholders. However, very few took advantage of it. Pharmaceutical company Merck insists it must demand exorbitant amounts of its medicines to fund new research. The company spent $10 billion on research and development and $14 billion on share repurchases and dividends in 2018. One report suggests that if Walmart had converted half of its money on stock buybacks into wages, 1 million of its lowest paid employees, most of whom live below the poverty line, could have earned a 50% wage increase. As speculation rather than productive investment became the fuel of the stock market, big investors began to devote more time to playing games like Short Circuit. Redditors set their sights on silver after GameStop frenzy. Silver prices surged to a 5-month high on Monday. Silver mining stocks bounced, and coin-selling websites were overwhelmed by small-time investors piling on the metal edge. Silver became the last asset to rise after the GameStop frenzy. When the Redditors raised the share price, the big fund managers bet on. Since the middle of last week, thousands of Reddit posts and hundreds of YouTube videos have encouraged small investors to buy silver, partly believing that raising the physical price could hurt big investors making papers bets that will drop. The Reddit crowd has turned its eyes to a bigger whale in order to try to catalyze a short-term pressure in the silver market, said Kyle Rhoda, IG Markets brokerage analyst in Melbourne. This is their big, brave Moby Dick moment. Spot silver reached its highest price since August 11, with $28.98 per ounce. Silver mining shares jumped more than 15%, and physical silver demand more than doubled since Thursday. In a spillover from the United States markets, silver exchange mutual funds listed on the Tokyo Stock Exchange rose more than 10%, while shares of Australian silver explorers jumped between 20% and 40% on Monday. Data from the iShares Silver Trust ETF on Friday showed that more than 37 million shares were created in one day, each representing 1 ounce of silver. Aaron Kopp in Florida was one of the investors who received an order of 500 silver coins. Kopp has been trading silver for 8 years, but said he has more than 10 friends who are just starting the silver trade due to the latest news. The big problem is that we live in a time when big banks are essentially shortening silver. Central banks and hedge funds control the price of big assets, and this allows them to control everything else, which undermines everyone's ability to live in a freedom and have a future. Nobody cares about the common man, they're just a pawn, and everybody feels like a pawn. That is why it starts. That is why we don't feel like pawns. Craig Hemke, precious metals analyst and editor-founder of the TF Metals report, said after GameStop there began to be discussions what are other stocks with a massive short position that they could move to next. Hemke said the silver mining sector in the United States and Canada had been a victim of predatory short selling, but that for this silver squeeze to be effective, it's going to take a lot of patience as the pricing system is entrenched and has been entrenched for 40 years. What they were able to do with GameStop is only one individual stock, and on the other side are the hedge funds which can get squeezed with margin calls. That's going to be challenging to do with silver because it's a big market and the entities holding the short positions are held by the banks and they have deep pockets. Dr. Elvis Cernacek, senior lecturer at the University of Sydney Business School, said silver was a much more liquid market with a lot more buyers and sellers, so that the newly empowered investors will represent much less significant percentage of traders. Janasek was critical of what he described as market manipulation. If institutions did this to inflate prices in this way away from fundamental values, they would receive enormous fines in regard to manipulating the market, he said. If you make any investment or legal decision, it is advised to consult an expert before making this decision.